Good afternoon, I'm Jennifer Christian and I work as a portfolio specialist in the investment management team, and I'm going to provide you with a brief overview of this week's market summary. It has been an important week for UK data. UK CPI inflation slowed again in December to 1.3% from 1.5%, its lowest rate since November 2016 and well below the Bank of England's mandate, which is to target inflation at 2%. UK inflation has been trending lower in recent months thanks to the stronger pound. Despite widespread discounts and offers in the run-up to Christmas, UK consumers clearly decided to tighten their belts as UK retail sales fell 0.6%. This now means that retail sales have fallen or stagnated in each of the past 5 months, which is the longest run without growth since records began in 1996. UK GDP contracted by 0.3% during November 2019. Now, while monthly GDP figures can be volatile, especially given election and Brexit uncertainty, this reading means that Q4 GDP will at best stagnate as December GDP now needs to grow by around 0.2% in order for the economy to show expansion over the quarter. And that looks unlikely given the role households play in the economy, as household expenditure accounts for about 60% of the UK's economy. These weak UK data readings confirm to us that UK interest rates should be cut as the economy clearly isn't booming. Interestingly, although Bank of England policymakers were still suggesting they expected UK interest rates would need to rise following their December meeting, one policymaker this week stated that he would be voting for a cut in UK interest rates at the next meeting if key data did not show improvements. Unfortunately, while it finally appears that there is a growing awareness among some of the Bank of England policymakers that UK interest rates need to be cut, given the next Bank of England interest rate setting meeting is less than 2 weeks away, they could still be outvoted by the majority given their mixed recent communications, at least for now. US equities were among the best performing markets over the week following the signing of the partial trade deal with China, which commits China to do more to crack down on the theft of American technology by Chinese companies. Additionally, while headline US CPI inflation rose to 2.3% in December from 2.1%, the Fed has signalled it is open to letting inflation run hot, especially as its preferred inflation measure, the core PCE deflator, remains below their 2% target. Elsewhere, Chinese data signalled that the economy was stabilising. Trade data for December showed exports rose 7.6% after a drop of 1.3% in November, while imports jumped 16.3% from a paltry 0.3% increase in November. Now that's all from me this week, and don't forget, if you haven't already, you can also read a more detailed insight into matters affecting the markets in the email.